So, if you checked your portfolio this morning and saw a sea of red, well, you are definitely not alone. A sudden, sharp dip just hit major assets, from stocks all the way to crypto, and the big question on everyone's mind is what on earth just happened? Well, today we're going to decode that dip.
Okay, let's dive right into the central mystery here. During the Asian trading session, both Bitcoin and the S&P 500 took a big, coordinated dive, and it pretty much sent shockwaves through the market.
And almost immediately, the headlines started pointing fingers, right? All of them at one country, Japan. The story goes that some announcement about a future interest rate hike completely spooked the markets. But does that story actually hold up? As we're about to see, it's got some pretty serious holes in it.
Okay, so first things first, let's just quickly set the scene and take a look at the damage.
And yeah, the damage was pretty clear across all the riskier assets. Bitcoin, which is always the most sensitive, took a decisive fall. The S&P 500 followed it right down. But here's where it gets interesting. Gold, the classic safe haven asset, did the exact opposite. It actually went up. And that's our first clue that something a little more complex is going on here.
All right, so now let's really dig into this popular theory about Japan. Let's put it under the microscope and see if it holds any water.
So, the theory is pretty straightforward. If Japan raises its interest rates, a hawkish move, then Japanese investors would sell off their foreign assets and bring all that money back home to get better returns. This huge movement of cash would act like a giant vacuum, just sucking money out of the global markets and causing a crash. It's a neat theory, but the timeline just doesn't work.
And this is where that whole official story really starts to fall apart. The claim is that Japan's announcement immediately tanked the markets. But the reality? The key event this entire theory depends on, the Japanese yen getting stronger, actually happened weeks ago. And the market's reaction back then was the exact opposite of a crash.
Just look at this timeline. On November 20th, the yen starts to strengthen. That's the supposed trigger, right? But what happened the very next day? On November 21st, the S&P 500 kicks off a 9-day rally. On that same day, Bitcoin starts a 7-day rally of its own, surging 15%. The markets were absolutely booming after the event that is now being blamed for a crash weeks later. The timeline, it just doesn't fit.
So if Japan is off the hook, we need a new suspect. And that, my friends, brings us to the real driver here, liquidity.
This is the million-dollar question, isn't it? If the obvious culprit has a rock-solid alibi, we have to look for a different answer, one that actually fits the evidence that we're seeing.
And to find that answer, you need to understand this really crucial concept, the impact of global liquidity. The amount of cash that's just sloshing around the financial system, it isn't immediate. Think of it like turning off a giant faucet. It takes a while for the water pressure to drop all the way through the pipes. Well, in finance, that delay is about 90 days, as the change kind of ripples through the system and hits the most speculative assets first.
So what this means is we've been looking in a completely wrong place. The trigger for this big drop wasn't some news headline from yesterday. It was a process that started in the United States way back in mid-July. We're just feeling the delayed shockwave now.
$600 billion. That is the staggering amount of liquidity the U.S. Federal Reserve has pulled out of the system since July. And guess when that whole process officially ended? December 1st. See, the timing isn't a coincidence. It's cause and effect, just playing out on a 90-day delay.
But here is the critical takeaway, and it's potentially good news. That massive liquidity drain, it's over now. In other words, just like the quote says, the worst has passed. We are feeling the aftershock for sure, but the earthquake itself has stopped.
You know what? This liquidity idea perfectly explains why different assets reacted so differently. Bitcoin, which is like the canary in the coal mine for global liquidity, it fell the hardest. The S&P 500 got hit. Yeah, but it was kind of cushioned by strong performance in the tech sector. And gold? It just marched to the beat of its own drum, pushed higher by other things, like massive buying from central banks.
Okay, so now let's zoom out a bit to the bigger picture, because there's this really fascinating conflict playing out on the world stage between central banks and their governments.
What we're seeing is a global tug-of-war. On one side, you have the central banks, and they are slamming on the monetary brakes. They're pulling back liquidity and raising rates. But on the other side, you've got governments hitting the fiscal gas pedal, approving these huge stimulus packages and massive spending plans.
And we're not talking small change here. These governments are making enormous commitments.
Japan's approving massive stimulus, basically betting the global economy can handle it. Meanwhile, Germany is on a path that will see its public debt swell to a staggering $3 trillion by 2026. All of this spending is going to require issuing just enormous amounts of new debt.
So where does all this leave us? Well, based on everything we've looked at, the path forward really comes down to two key phases.
So let's just recap. We've just lived through the painful, delayed effects of central banks pulling money out of the global financial system. That was the dominant theme, and it all led up to the drop we just saw.
But looking ahead, the story is set to flip completely. With that contraction phase now over, and with governments committed to all this massive spending, someone has to buy all that new debt. And eventually, central banks are going to have very little choice but to start injecting money back into the system to fund it all. So the focus just completely shifts. The Fed's balance sheet reduction, their QT program, it's done. The conversation is no longer about tightening. It's now about the inevitable next wave of easing, and the only question on every major investor's mind is not if, but how much. And that leaves us with a final, crucial question to think about. As governments around the world commit to trillions in future spending, does anything else even matter anymore besides central bank liquidity? As you watch the markets, just consider whether this has become the one variable to rule them all, reshaping our entire financial landscape.